Good morning, everybody. For those who joined us from the US or the Western Hemisphere, good evening. I'm Alfred Schipke, the director of the East Asian Institute, and I very much welcome you to our today's policy forum titled US, Europe, and China, Macroeconomic Developments and the 2026 Outlook. The way we're going to organize ourselves is we will discuss today the US and Chinese outlook and reforms. Because of the time difference, we will have a second event on January 28th at 10 a.m. here in Asia, at 10 a.m. Brussels time, and 5 p.m. here in Asia. I'm very glad to be joined by my colleagues, Jason Furman, who is professor of economic policy at Harvard Kennedy School. And before that, he also served as chairman of the Council of Economic Advisor in the Obama administration. Good evening, Jason.
Evening, morning, whatever it is to all of you.
Thank you. And then by my colleague and friend, Huang Yiping, who is the Dean of the National School of Development and a professor of economics at Peking University. He's also a member of the Monetary Policy Committee of the People's Bank of China. Good morning, Huang Yiping.
Morning, Alfred.
And then also my colleague and friend Guo Kai, who is the executive president of the CF40 Institute. He's also a non-resident senior fellow here at the East Asian Institute and a former deputy director general at the People's Bank of China. Good morning, Kai.
Good morning. Good evening.
So again, we have a fantastic group here to discuss the US and China economic outlook. The way we will proceed is we will first start out with the US and Jason, and then do a Q&A session. Please feel free to put your questions in the chat, and then we will move on to the China part. With that, I'm going to pass the baton to Jason. Walk us through what the heck is happening in the US.
Great. Well, it's great to be with all of you, and great to be with Huang Yiping and Guo Kai as well, who I've had so many great conversations on these topics with over the years, and glad to have another one in this setting. I'm going to be relatively quick on the US macroeconomic developments and outlook because I suspect a lot of the questions and things people want to discuss are related to policy and related to trade policy in particular. But let's just do a little bit of context in terms of where the macro data is. GDP growth has been very strong. It's at roughly the 80th percentile of historical performance. Some of this has been timing shifts, the negative growth in the first quarter showing up and being offset by higher growth later in the year. But overall, if you're looking at GDP data, it looks like the United States economy is very strong. On the other hand, and that's being driven by robust consumer spending, strong business equipment and IP investment, especially in data centers, which were responsible for 1/2 of the demand in the first half of the year. A narrowing trade deficit has provided some modest support. We'll see where that goes. And at the same time, the Fed has been contractionary in terms of residential and structures investment. So GDP growth very strong, but at the same time, the labor market is softening dramatically. Job growth has averaged less than 50,000 jobs a month in 2024. In 2025, in 2024 is more than 100,000. In 2023, it was more than 200,000. Much of this appears to reflect a structural slowing of the labor market as immigration has been both restricted and deterred. Some of it is hard to draw new people into the labor market. But broadly, it's also a little bit puzzling how GDP is so strong and the labor market is so weak. Are one set of numbers wrong and going to be revised? Is this something about the composition of GDP? I think that's the most likely explanation. Things like data centers don't require a lot of employment. And, but the most favorable explanation would be that this is about productivity growth, that AI is finally showing up. I'm skeptical that that's happened to date for a variety of reasons, although I expect it will. The unemployment rate has continued to gradually rise. It's a little bit above the Fed's implicit target. Some of it may have been moved around in a more volatile fashion by the government shutdown that lasted for all of October and part of November. That's why it bounced up. It's bounced back down a little bit. So again, all the macro data, a little bit hard to read because of that government shutdown, both interrupted data collection and also affected the actual economy and the way it's measured. Finally, inflation is above target, but it's easing. This is the CPI. There are, again, some spurious things related to the shutdown. I think underlying inflation is more like 2.5% rather than the 2% rate we've seen in the CPI recently. And, big question here is how much of this is tariff inflation? Probably about half a point. How much of tariff inflation is transitory? The best guess is all of it, but there's still a substantial concern that maybe it gets built into expectations as some form of tail risk. So broadly, the key questions for 2026 are how much AI shows up in demand, how much AI shows up in supply in terms of productivity demand. There remains very high policy uncertainty around trade. I had written this before the latest round with Greenland, so even more uncertainty around trade than I might have said. The Federal Reserve and its independence is an important question. There'll be a Supreme Court hearing on that question tomorrow, at least one aspect of that question, and then the fiscal stance. Given the contradictory data about growth and jobs, there's a big confidence interval around the overall outlook. My baseline would be continued growth with moderate inflation, but if you're a central banker, you have to be attuned not just to the center of the distribution, but the risks. That's where we are in terms of the macroeconomy. I thought maybe I would just address two questions that were sent to us in advance. There were other questions also. And then I'm happy to talk to, have a conversation here in any way. One question is, will Greenland be a catalyst for a new trade war? Or will President Trump taco? Trump always chickens out, as people know. I wish I knew the answer to that question. A week ago, I thought broadly it was likely that tariffs were going to end 2026 lower than where they started. In general, there have been more cases of President Trump calling off threats and adding exceptions to tariffs rather than tightening them. The tariffs are relatively unpopular politically. The central economic issue in the American political debate at the moment is affordability or the level of prices, and tariffs obviously have an impact on that. And moreover, and this gets to a second question, the Supreme Court will rule any day now on the International Emergency Economic Powers Act, IEPA, which is the source of a bit over half of the tariff increases we've had under President Trump. And there's, I think, a decent chance that they would in some way limit those tariffs. So broadly, up until a week ago, my thought was that tariffs were more likely to go down than to go up. The Greenland threats, if followed through, would be a strong disproof of that. One possibility also is just escalation. If Europe retaliates against the United States in any way more serious than just delaying the implementation of the trade agreement, then it's likely that the United States would escalate further. And so TACO is completely possible, but an escalation in response to a European counterattack is also completely possible. And I think the market moves today where you see the dollar weakening at the same time that interest rates are going up is exactly the type of fear that we saw in financial markets in April, and that uncertainty about President Trump is back. If the Supreme Court strikes down IEEPA, the president has a lot of other authorities he can use to impose tariffs. They're all limited in different ways. Some of them are time limited. Some of them are limited in terms of how flexible you can be in using them. Some of them require a longer time to establish and prove them. I would think that he would reimpose some tariffs, but be okay because of the political issues around affordability with other tariffs going away. But that assumption I'm less confident of after the whole Greenland incident as well.
Maybe I could follow up with one question that is on everybody's mind is I think what we have seen in 2025, I think for the US, but also for other parts of the world, I think for the global economy in general, is that despite all the shocks that we've experienced over the last year, the macro, as you highlighted, has remained relatively resilient. I think the question really is, and in part in the US, I think driven also by the strong investment related to the AI sector. The big question, I think, is what is going to break the camel's neck? Is this just something that we have been lucky and we're going to see it maybe in 2026? What is it that really could upset this equilibrium?
Right. A few things happen in terms of the tariff projections. One of them is the tariff rate has been cut in half from where it started. But as I said, we'll see which direction that goes. A second is there has been considerably less foreign retaliation than most people have expected. And then third is that there were always two types of effects. One was related to trade. And if you modeled that out, most of the computable general equilibrium models predicted it would take like half a point off economic growth. And then there was uncertainty, an additional set of fears that would cause businesses to pull back from investment. Well, the uncertainty seems to have not been important and not materialized, and economists and others may have overstated the findings of trade models, which I think were sort of more accurate than maybe the rhetoric around them. In terms of what breaks the camel's back, one is if AI does turn into a bubble, and there's two respects in which it's a bubble, both it could be a bubble. One is market valuations, and the second is the degree of real economic activity, especially data center build out and everything that goes with that, like energy and the like. So, to me, that is a bigger risk, not my central scenario, but a bigger risk than anything associated with trade. On trade, it would have to be considerably higher tariffs and a much greater degree of uncertainty. And frankly, if President Trump leaves China in April and brings the tariff rate back to 125 and China brings it back to 100 or whatever it had at its peak, it would be, I think, a massive trade stoppage between the United States and China. Again, not something I at all predict would happen, but I'd be worried about that. Anything short of that, extra 10% tariffs on Europe, that's a little bit bad for growth, but not anything dramatic.
Maybe I should give Huang Yiping also the chance to ask a question.
Okay. Thanks. Thanks, Jason, for a very interesting and insightful view sharing. I have a question about that sustainability in the US. And I heard so many people telling me the public debt as a share of GDP has been rising and probably will continue to rise. That's probably not sustainable. But I guess given the current institutional setting and the style of the president's policymaking, fiscal discipline is probably difficult to expect to have a material impact in the near term. What would what would you expect going to happen in the coming years in the short and the longer term on growth on a financial market? Could AI revolution offer a solution? Maybe I already asked too many questions in it, but the central point is fiscal sustainability.
Right. So it is very likely that we're on an unsustainable path for debt. For it to be sustainable without a change in policy would require productivity growth to rise from about 1.7% to about 3%. I view that as a 10% chance or less. So 90% of the scenarios would be scenarios in which we are on a fiscally unsustainable course. There has been relatively little political interest. You don't see voters caring very much about the deficit. You don't see the political system caring very much about the deficit. And I think part of that is that for the last couple of years, the 10-year Treasury has been trading between 4 and 4.5, not the types of levels that you would associate with anything resembling reason to sort of panic. And so in some sense, it's not just the voters that aren't panicked, it's the market. And that speaks to how severe and urgent the problem may be. So I think it is a real problem. I'm actually not sure how severe and urgent it is as a problem. In terms of what could change it, one possibility is the market could change and interest rates could go up. Another possibility, though, is both Social Security and Medicare, the old age pension fund and medical fund, are insolvent within the next decade. And that would force the political system to pass a law. Now, they could choose to pass a gimmick or they could choose to pass something real. We'll see.
Thank you. Thank you.
Gokai, do you have a question that you wanted to raise?
I'm good. I'm good.
Maybe then I could come back with one that was raised, and it speaks to the latest U.S. national security strategy that wants to rebalance America's economic relationship with China, prioritizing reciprocity and fairness to restore American economic independence. So the question, I think, is, in your view, what implications does this have for a new or evolving U.S. policy and attitudes toward China this year?
Right. There were parts of the U.S. national security strategy that were enormously controversial, both between the political parties, but also within the Republican Party. That would be especially the case for the way in which it de-emphasized the United States relationship to Europe. That's something that President Trump believes. Many Republicans disagree with him. Many Democrats disagree with him. When it comes to China, though, and the quote you read about rebalancing America's economic relationship with China, that is broadly reflective of agreement among policymakers in both parties. It's how I would describe policymaking under President Biden with respect to China and to some degree under President Obama as well. We have an issue with global imbalances. The United States is an enormous debtor country. China is, at least on a flow basis, annually an enormous creditor country, with that growing. think the United States issue is largely made in the United States. The China issue is largely made in China, but it is the case that world current account deficits, balances need to add to zero. And so neither one would be possible without the other. To the degree that trying to talk about rebalancing is complementary and helps both countries take better steps for their own economies, I think it's a very good dialogue to have. So in some sense, rebalancing is on the G7 agenda. The French put it there. It's a big part of discussions in a variety of settings around the world. And it involves internal steps, but to some degree thinking about what's going on externally as well.
But I think then that gets back to Huang Yiping's question earlier. Both sides have to address it, and I think we'll talk about the Chinese side in a second. But if your prediction is that the fiscal will not change anytime soon in the United States, so what is it that gets savings up in the US? And I think in the case of China, we'll talk a lot about consumption. And when you talk about the G7, talking about addressing imbalances, there was a time when you had all parties come together and say, okay, each side has to focus on getting their own house in order. But it sounds a little bit that, rightly so, the emphasis is on China addressing its economy and rebalancing its economy. But are you confident that, at the G7, people are equally voiceful to push the US to do what it takes to bring down or increase savings and ultimately, therefore, reduce the imbalances?
Yeah. So, a bunch of different questions. First of all, I don't think the US current account deficit is that worryingly large. It's on the edge of too large from my perspective. The budget deficit is more clearly too large. And by the way, if we did something at the budget deficit, as you just alluded to, probably about 50% of the deficit reduction would show up as a current account reduction. Absent that, the main way in which American savings would rise or American consumption of imports would fall would be a weakening of the economy. To some degree, the trade deficit in the United States is a sign of American strength and the strength of American consumers, the strength of American demand. Something like the data centers, the chips are largely produced abroad, and we're having an AI boom. And so, and the flip side of that, of course, is China's surplus is to some degree reflective of, from my outside perspective, and I know vastly less than everyone else here about China, weaknesses in Chinese demand and the like. And so there's a bad way to solve the US problem, which would be a weakening and slowing of the economy. And then there's a good way. The good way, I think, largely would have to happen through the government and through, reducing public dissaving.
We have one question. I think that's a perennial question that everybody asks. As it relates to tariff, at the end, who has been paying the tariffs? Producers, consumers, or importers?
There are different estimates, but exporters, other countries, are probably paying between 0 and 20% of the tariffs. The rest are being paid by Americans. Within the United States, the majority are being paid probably by businesses absorbing them, but a still substantial and hefty minority are being passed on to consumers. I expect over time, more of the tariffs will be passed on to consumers, assuming the tariffs are still there. There's some businesses that were hoping they would go away. They didn't want to anger President Trump. They didn't want to anger their customers, but they won't be able to show restraint forever. So, I expect the foreign share to be not zero, but relatively small, and things to be shifted more to consumers over time.
Maybe a little bit looking forward and this looking at the crystal ball, but maybe reflecting a little bit U.S. priorities. A question is related to President Trump's upcoming visit to China. People talk about potentially in April. What topics do you see will appear on the agenda, and are there specific areas where the two sides might be expected to strike a deal or reach an understanding?
From the US side, the trade deficit has been the overwhelming concern. When it comes to other trade agreements with Europe, with Japan, with Korea, it ended up being more about foreign direct investment into the United States rather than purchases. I don't think that's the model for China. I think it's more about purchasing things from the United States than it is about investing in the United States, given all the set of concerns associated with FDI coming from China. But that's on the US side. And then the chip exports, which have been something, of interest to China and something also of interest to the United States for a variety of reasons. I imagine will be another big part of the conversation. But, I'm glad. I think when these leaders get in a room, they tend to have good conversations. It takes the temperature down and, more understanding, more agreement between the world's two largest economies is something I'm very much in favor of and hope is what we see.
I think you kind of already alluded to that, but if you were to think about the Chinese side, one of the questions they could argue is, are there areas for Chinese investments into the United States that fall outside of national security? Do you think there's any prospect that, at these meetings, potentially the Trump administration would consider, allowing Chinese investments to come in, or in the current political environment, that will be very difficult to do?
I don't know. I don't have a good feel for where that stands right now. I am in favor of more Chinese FDI into the United States. I think we have a lot to learn from China, especially in things like advanced energy related technologies. And so, in some ways, I think the United States sometimes makes the mistake of thinking we're at the cutting edge of everything, which might have been true once upon a time. But right now, China's at the cutting edge of all sorts of things, and the United States remains at the cutting edge of all sorts of other things. And that's why FDI and trade can benefit both economies. You just saw a significant change in in Canadian policy towards Chinese trade. I think you're going to see more FDI into Europe. I think that's what they want. I'm just less sure where it stands in the United States.
Thank you very much, Jason. I think that was a very good start. We can, of course, come back at the very end with open-ended questions when we finish the China part. But maybe we can move on to China, and I think you kindly agreed to take over the baton from now. I think first Guokai would start, but Jason, you're in charge.
Great. Guokai, look forward to what you're going to talk about, and then we'll hear from Yiping.
Okay, I'm going to talk more about short-term Chinese macroeconomy, and probably Yiping will move to the imbalances, and Alfred will talk more about fiscal reforms. There are a lot of discussions about the strength and the direction of travel for the Chinese macro. As far as we can see, we believe actually Chinese macro holds up pretty well in 2025. I would describe it has been quite resilient despite many shocks happened in 2025. If you were asked a year ago, China would be subject to 35% of additional tariff from US. The ongoing deflationary pressure is still there, and there is another round of property correction Could you imagine China managed to grow 5% for the whole year? Probably no, but actually China delivered 5% growth for the whole year. I think that is quite a surprising and also reassuring performance. But if you look more carefully at the trajectory of economy, it was more front-loaded in 2025. So the first quarter was starting very, very strong, and then growth started to moderate over the year. If you really ask what's happening behind that, I think what happened back actually in 2024 was important. The big policy pivot since September 2024, I think put a floor on China's growth. At the time, the Chinese government rolled out a huge package, particularly a fiscal package, to shore up the economy, and that changed the whole sentiment and the trajectory of the economy. Moving to 2025, the year started strong on the back of the fiscal stimulus announced in 2024. Then there were three shocks, I believe, hit the Chinese economy since the second quarter of 2025. The first one was obviously the U.S. tariffs. The tariffs didn't really have big impact on China's export. I can come back to that later, but the uncertainty it created actually have a big impact on private sector behavior, which led to a lesser demand for credit of the private sector, and also a renewed weakening of the housing sector. Then come this anti-involution campaign, which I think is justified to making the supply and balance conditions in China more aligned. But that has a consequence of actually of lesser investment in certain sectors, also lesser production in certain sectors, which become a drag to the growth in the short term. A third shock is not necessarily shock, but a third factor is fiscal spending. Our fiscal spending was more front-loaded this year. There's a lot of money went out of the door in the first half of the year, and over time it become less. That makes the fiscal trajectory more expansionary in the first half compared to the second half. Also, the composition of spending also changed a little bit. Some of the expenditure is to recapitalize banks, is to help the local governments to repay their debt. Those spendings, although very, very helpful, it didn't translate directly into domestic demand, which also explains some of the weakness of domestic demand in the second half. So all in all, I think China's economy was subject to a few shocks that explain why the economy started to slow down since the second quarter. Next slide. But if you look through all the data, I think at least as far as I can tell, you see a lot of resilience in the data. Consumption, retail sales seems to be declining month by month in terms of growth. A lot of that is due to the waning impact of the trade-in program, which started since September, October of 2024. That the impact has been waning. That's why the retail sales seems to be cooling off. But if you look at those goods that are not subject to the trade-in programs, it held up pretty well, around 3 to 5% growth. That showed there are some underlying resilience in terms of consumption. Fixed asset investment is very, very weak towards the end of last year. It was in double-digit decline if you look at the most recent data. But if you look at the micro-level data, listed companies, sales of capital goods, and the consumption of iron ores, those are typically linked to investment. Actually, we didn't see a dramatic decline of investment. We believe there are some data issues that need to be reconciled, but I think the headline fixed asset investment decline probably overstated the weakness of investment. Actually, investment was quite stable in our views. Somewhat slowed down, but quite stable. And a third point is that if you look at credit growth, I mean, household credit growth was pretty weak, but broad corporate credit growth was strong. So last year we have pretty strong overall credit growth for the whole year. That also is a signal to us that domestic demand is quite resilient rather than being very, very weak. Next. Coming back to trade, yes, you know, China was subject to 20 plus 30% additional tariff from US. That's why China's export to US declined by somewhere around 30% year on year after tariff. That's elasticity 1, which is what we estimated. But China's export to other places of the world surged. So overall export was, depending on how you measure it, was about 5%, 6% higher than 2024. A lot of that is actually rerouted trade to the US. So goods going through Southeast Asia, going through Mexico, going through Europe, then eventually went to US. I mean that is not necessarily transshipment as defined in the US administration. It's really that Chinese companies build up this extensive global supply chain so they can reroute their manufacturing and reroute their trade subject to the US tariff. I mean, in addition to that, Chinese export to ASEAN, Africa, and other emerging markets also growing very, very strongly. In addition to those rerouted trade, you know, there are genuine demand from those places, and the Chinese goods are very, very attractive. Coming to next, one big question mark is about the weakness or strength of the property market. I mean, without doubt, it's continued to decline on a quite big scale, particularly towards the end of the year. But if you look at more carefully of that sector, you found that actually developers, their defaults rate start to ease, and it's not a panic type contraction. It's a more orderly market clearing process happening, which we believe is healthy. You know, we probably will still continue to see the housing market to decline in 2026, but we believe the scale and the impact on macroeconomy will be less in 2026. Going next. Another sign of stabilization is really when you look at prices, actually both PPI and CPI improved in 2025. We are not yet in the positive inflationary environment yet, but both of the reading of CPI and PPI start to improve. And if you look at more carefully of what's happening to both PPI and CPI, you see underlying stabilization of prices. So we have 3-4 years of continued price decline. In 2025, you start to see sign that price started to stabilize. So that to us is a reflection of a better alignment of supply and demand within China. Looking to 2026, we believe external demand will continue to be to be very, very strong, particularly given that I think we believe in the baseline case, but the bilateral trade relationship between US and China will be more stable compared to 2025. It is also the first year of the 15th five-year plan, so there will be quite strong policy support to make sure growth will be healthy. Our projection for the year of 2026 is that growth will be approaching 5%, maybe less than 5%, but approaching 5%. Again, I think from policy perspective, we think the most important policy is fiscal policy. Fiscal policy needs to have adequate support to the economy. We heard the Vice Minister Liao Ming said yesterday in his press conference. He said exactly what I just described. He said there will be sufficient fiscal. We will look out for that. We also think that some monetary easing is warranted, although the room to lose monetary policy a lot is not that much. The currency is on the move. We believe if there's appreciation pressure to the currency, PBOC may want to allow currency to move so that it both help alleviate some of the external concerns, also to send price signals to domestic companies so that there will be a better alignment of domestic demand and foreign demand. Of course, there are a lot of downside risks. I mean, if property sector have another bad year, you know, and the economy will continue to have a lot of issues. If the policies are lesser than warranted or lesser than we expected, the economy probably will also be having some risks. Again, the bottom line is that we believe that China's economy, having been through several years of enormous downward pressure, finally showed some signs of stabilization. And we see some moderate recovery in 2026, but that would be contingent on policy delivery. I'll stop here and thank you.
That was terrific. Want to go straight to the trade side. I was interested to hear you say you expected to see more support for growth in 2026 coming from the external sector. Does that mean you think the trade surplus will grow this year relative to last year? And what do you think the sort of desirable trade surplus would be?
The way I see 2026 is that demand from US will continue to be very, very strong given the AI boom in the US and the US, the AI supply chain also plus the electricity grid demand from Chinese export will continue to be very, very strong. And our baseline is having a constant tariff from US or even lower tariff if the two leaders having good meetings. So the US demand will be stronger compared to 2025. Europeans are doing some mild expansion, fiscal expansion, and militarization. A lot of that would require manufacturing inputs, which ultimately will be coming from China. So yes, we see export will be actually continue to be very strong, given strong external demand plus Chinese competitiveness and a better US-China trade relations. Regarding our surplus, the surplus itself may not necessarily be growing very large. If our projection of a mild recovery in domestic demand also take hold, we actually projecting that our investment will be slightly higher than 2025, and consumption will also have a moderate recovery. If that's the case, we probably our surplus probably be around constant compared to 2025, not massively more than 2025. As a percent of GDP, it will be probably less than 2025. But again, we'll probably continue to run quite a big surplus, but not necessarily growing bigger in 2026.
And you mentioned if the economy has adequate support, in 2026. If things are weaker than you expect, with inflation so low, what do you see as the risks to expansionary macroeconomic policy, and what are the pros and cons of different ways of going about expansionary macroeconomic policy, whether monetary, fiscal, other means?
Right. The way I see Chinese policy space is that now it's mostly fiscal. I think that's Alfred title later today. Monetary policy have really relatively limited room to maneuver, given that actually our rates are pretty low right now, and the net interest margin for banks is at a historically low. The central bank is quite reluctant to lower rates further, and even if they were to lower rates, I mean they probably have another 20 to 40 basis points room. That's maximum they can cut. So we are not expecting too much from the central bank part. So it's mostly will be fiscal. What I would worry is that sometimes Chinese fiscal policy tend to be pro-cyclical in some years. So when the economy is performing less than expected, revenue will be less than expected. And sometimes the spending actually will start to contract due to the revenue underperformance, then which will translate into a pro-cyclical contraction when the economy is performing not well. That will create a cycle that's going to be quite detrimental to growth. But at least since September 2024, I think the Chinese government is trying to do consciously to do countercyclical fiscal. And, we are still counting on that. If that's not happening, I guess we're going to have a very different projection for 2026.
Great. And I think, Alfred, I would move on to Yiping unless you have questions or you think others have questions.
No, I think it's good to move on, and then we'll come back to it in the final Q&A.
Great.
Okay.
Yiping, the floor is yours. And thank you.
Thanks, Jason. I'm happy to just continue the conversation. Guo has started. He started with a macroeconomic outlook, and then he mentioned the 15th five-year plan. Some of the key policies are being discussed recently. So I will take this discussion forward a bit to look at somewhat more medium-term economic outlook, but really the reconditioning of the growth model, how to make the Chinese growth sustainable in the medium term, and focusing more on the rebalancing of the Chinese economy. If we look at the first few decades of China's economic reform and open door policy, the growth model was often characterized as relying on external economic circulation, i.e., depending on capital, technology, even raw materials coming from overseas, and then process it at home and re-export it to the international market. That's why exports and FDI were very important factors contributing to the Chinese economic growth. That's becoming difficult nowadays. And I think for two reasons. Number one is, for whatever reason, the international market is much less open compared to when China started economic reform. And President Trump's tariffs are just an illustration of these trade barriers being seen around the international market. The second point, which is also very important, is that China grow from a small country economy into a larger country economy, i.e., during the early years, China can export whatever it has, but now it becomes more difficult. For instance, at the beginning, a couple of months ago, when people heard China's trade surplus, even during the first 11 months, exceeded $1 trillion during the first 11 months, and then it became a big news. And I think, I guess what Jason was hinting to when he asked the question about the trade surplus was related to the nervousness of the rest of the world. I just checked the number, and for the whole year, it was $1.19 trillion trade surplus. That's a huge number on the rest of the world. I guess the difference is when you become a large country economy, the reaction function from the rest of the world changes, and that's why people become nervous. So both these reasons make it much more difficult for China to rely on external economic circulation to drive growth. That's why the policy already is moving toward transitioning to a dual circulation, but relying more on domestic economic circulation. And here, obviously consumption is a big story. When you want to rely on domestic economic circulation, essentially two pillars coming with it, and these were identified by the 15th five-year plan. Number one, the so-called development of the new quality productive force, the new industries, innovation, and so on. The second is expansion of domestic demand. But I think really the key is household consumption. And household consumption has been quite low for if you look at the numbers. So here, the lowest number I saw from the official statistics was in 2010. Consumption was about below 50% of GDP. It came up during the last 1.5 decades, and now it's probably close to 60%. That's still way below the average of most emerging market economies and certainly developed countries. So we are seeing the numbers slightly moving up, but the overall share is still very relatively low. And that's why we often say the Chinese growth model has a typical feature of strong supply and a weak demand. I have to say this has been around for a very long time. It's not new. But maybe the reason why this did not stop China from growing by an average of almost 9% every year during the last 4.5 decades was because China was able to rely on the so-called external economic circulation, i.e. when supply is strong, demand is weak, you potentially have a domestic excess capacity risk, but you were able to export out of the problem, and that was what happened. And that's why when I mentioned earlier on, external market is less open and China become a large country economy. These two means that old model could not continue. If we cannot export everything out to the international market, then we're going to see bigger excess capacity risk and the pressure for deflation. And I think this is what exactly we are seeing at the moment. And so there are many reasons why consumption is being low. And I certainly can think of two reasons, immediate reasons. Number one is if you look at the way the resources are allocated, a large part of the resources were allocated by governments, especially local government. And their saving ratio is much higher than household. If you look at household saving ratio, they're not low, but they're not extraordinarily high. But resources were captured by the local governments, and they allocate almost everything into investment. And that's why saving ratio is quite high. The other side of the coin is obviously household income as a share of national income is not particularly high. That feature was very typical in most formerly central planned economies. And China is certainly moving away from that system, but the transition has been gradual, and the local government still control the allocation of some resources. The second reason I think is related to the fact that China had surplus labor for a very long time. So China depended on exports of labor-intensive manufactured goods. Exports grow rapidly, the economy grow rapidly, but household income as a share of GDP did not grow because the wage rates were flat. And that's why I think these two reasons, plus maybe the lack of a well-developed social security system, means the consumption were relatively weak, certainly in a relative term as a share of GDP. But the point I want to make here is actually rebalancing already happened. And the Chinese government certainly from as early as 20 years ago start to want to make efforts trying to address this problem, although people still complain. If you look at most of the indicators, consumption share of GDP, investment share of GDP, and the current account surplus as a share of GDP, they were actually moving all in the right directions. But maybe the shares declined, but in some cases, like what I just mentioned, the trade surplus, the absolute measure of the numbers they actually became bigger because the country become much bigger. And that imposes the new challenges for the rest of the world. And this is why excess capacity risk, in fact, are probably exacerbated. And that's why the prices become very, very sluggish. There is also a dimension of the manufacturing story and the evolution. I'm not getting into it, but when a country accounts for 1/3 of the global manufacturing industry and the manufacturing accounts for 25% of GDP, it becomes difficult to avoid overcapacity risk if you don't have a very strong domestic consumption demand. So this is why when I look at, for instance, the 15th five-year plan, the discussion about the policies, it identifies two growth mechanisms, as I mentioned at the very beginning. Number one is new quality productive force. That means we need to continue to upgrade the industry to stay competitive. The second is to expand the domestic demand. These two pillars, in my view, are very important for a smooth domestic economic circulation. But when I look at, for instance, the recent policy messages from the Central Economic Policy Work Conference, I felt that there was a little bit of fine-tuning of the policy focus, although these two policies are still most important in the design, in the planning. But in the 15th five-year plan, supply was discussed first, and then demand was second. In the annual conference, expanding domestic demand moved up, and I feel that maybe because in the short term, domestic demand becomes a main constraint on domestic demand supply condition, and probably in the near term sustainability of economic growth. That's why I think the focus is probably shifting a bit more to the demand side of the story. Although our supply side will continue to be very important, and I agree with Guokai, and I think the government is probably in a position now to design and implement more measures to support the growth in the near term. Although, and I think the 2 points he made, and I think both Alfred and I agree that more macroeconomic policy support is important, and number two, fiscal should play greater roles than monetary policies. But in order to rebalance what needs to be done going forward, and I just mention some of the things, then I'll finish. Number one, I think certainly to expand the household consumption, it really boils down to two fundamental measures. Number one is income, and number two is confidence. And we needed to do a lot of things to reallocate income, and so that household income can be a higher share of a portion of the national income. But at the same time, the social security, social protection are also very important. Last year, the government implemented some measures like trade-in policies to support the consumption. That's useful, but only temporary, and it's not sustainable. And I think we needed to focus more on fundamental measures to improve both on the income and the confidence. Market discipline would also be important, because if you have an overinvestment, and if we see lots of zombie firms, then it's difficult to get rid of the overcapacity problem. So I think market discipline, market clearance is also very important. Guokai already mentioned about the housing and exchange rate, so I'm not going to mention it. I think at some stage, we might need to look into the possibility of the central government leveraging up to improve or repair the balance sheets of local government, household, and maybe also financial institutions. Because there are high leverage problems in the Chinese economy, but if you look at the central government, total public debt is only a little bit over 20% of GDP. But the balance sheet problems are really constraining consumption and investment demand domestically. And that's why I think if at some stage the government can consider a plan to improve the balance sheet at the micro level by leveraging up its own liabilities, I think that's probably a useful thing to think about. And this is not in the official pipeline yet. So my overall takeaway is that I think the rebalancing is becoming a key constraint, a fact condition for sustainability of growth. Positive things already happening, as I mentioned, the trade surplus as a share of GDP already came down. Consumption share of GDP is already up, but it's a very gradual process. And at the moment, the demand-supply imbalance is still a key factor and reflected in the slow adjustment in the inflation rate and so on. So I expect this to continue to happen unless the government take decisive, aggressive measures. Otherwise, I feel that this adjustment, even though moving toward a positive outcome, eventually it will be a prolonged process. I'll stop here, Jason.
Great. That was terrific. So, Yiping, just a sort of bottom line, how much room is there to improve the quality of investment while reducing the quantity of investment? And to what degree is that, sort of better industrial policies and picking better sectors and better winners and losers versus setting a different sort of rule of the game and letting the market decide?
Well, Jason, this is a very good question and a very broad question. I will just highlight one point I want to make. That is changing the behavior of the local governments. As we all know, local governments played a critical role in driving economic growth ever since the beginning of economic reform, because one of the first reform measures was called decentralization. The central government decentralized the decision power to local governments, which immediately provide both autonomy and incentive for local government to compete with each other to drive growth. And that's why they did lots of things, building infrastructure, supporting industrial development, and so on. That was a very important mechanism driving growth. However, I think entering into the new phase of development, when the growth model transits from input-driven growth to innovation growth, the same kind of active roles by the local government sometimes became problematic because they probably were more capable of building large infrastructure projects than supporting new innovation like the AI revolution and so on. So at the moment, we are in a transition phase. And the transition phase is mainly caused by the local government liabilities. They have so much liabilities, and now their revenue is drying up. So that's why I think their spending is declining. My suggestion is that maybe this is a good opportunity for China to reform the central-local fiscal relations. Number one, maybe to allocate more revenues to the local government so that they can have their own spending responsibilities covered, because at the moment the funding shortage is a main problem. But at the same time, I think the local government should probably also scale back the spending responsibilities. Like they should do a lot of things the government should do, but not to do too much in terms of directly supporting industrial revolution, supporting innovation. My own reading, for instance, the EVs and the new batteries and so on, did a good job. But most of the local government provided the industrial subsidies, expanded the production capacity without necessarily creating breakthroughs in technology and innovation. So that kind of industrial policy did not really achieve what we usually would expect for you to really be to have a big innovation component in it. So I think what we should do going forward, and that's in line with the government policy goal is to let the market to play decisive roles. And I think it's time for the local government to step back a bit in terms of supporting innovation. Maybe providing some industrial policy is good, but focus on the result of innovation and use your own money.
Got it. And then Bert Hoffman, who I've learned an enormous amount about China from over the years, asks you how you would boost household income. And, just concretely and specifically, and he alludes to what would be my favorite solution, which would be a more progressive fiscal system. China's tax system is less progressive than many other countries around the world. Do you think that would be a good idea? Do you think that's a likely idea?
Well, I'm not sure if Alfred is going to address that problem. And I think a fiscal policy or income redistribution certainly would be an option. But at the moment, I'm not sure if this is going to be very effective, and it certainly would be popular politically. But I think at this stage, there are certainly things we can do. For instance, if the government really decides to let go the control of lots of decisions on resource allocation, maybe some of the income could actually go directly to the household instead of being captured by SOEs and the local government and then put all of them into investment. So give you an example, when the local government sell land, in most cases, the local government would just use the revenue to build an infrastructure or build an industrial park. Alternatively, you can just, put that money into a social security fund to support the consumption, or to distribute to the local residents, which is less likely to happen. So I think market-oriented reforms still has a long way to go in that cases. And we also needed to do lots of things in terms of increasing asset-related income. At the moment, household income are primarily wage income. And I think that needs to be changed, especially as the population ages very, very rapidly. So I think redistribution is important, but I'm not sure if this is a very effective and a politically popular measure in the near future.
Got it. Thank you. And I think, Alfred, we're going on to you unless you have a different plan.
No, I'm trying to bring it home by actually linking what Kai talked about, the conjunctional, and Huang Yiping now the rebalancing part, and I call it is mostly fiscal. Okay, nope. I was a little bit too fast. So the argument that I'm making is the part that links the short term with the medium term rebalancing is truly China's Achilles heel of the entire reform process. And there are interlinked challenges that China is trying to address. As we said earlier, for it to support the transition in the short term, additional fiscal support is needed. But equally important, for it to truly move away from an export and investment-led economy, it has to do what it takes to foster domestic consumption. And building on what Huang Yiping ended with, local governments today are still facing, a lot of them are still facing financial challenges. In the absence of addressing that, we will have a challenge to really rebalance the economy. So really the fiscal is linking growth. It is the critical part to instilling confidence, and that ultimately facilitates rebalancing. Next slide. So as Kai said, let's start out with the short-term fiscal support. And as was indicated at this meeting at the Central Economic Work Conference in December, there was emphasis on continuing to have a proactive fiscal stance, with the understanding is there is still a lot of headwind, especially coming from the real estate sector, and the latest numbers that we have seen support that. So fiscal support is needed. Now, if you look at some of the headline numbers, the fiscal deficit, for example, here the figure emphasizes official data. These are the different budgets that China has. And last year, it was close to 9% of GDP. So quite a significant deficit, right? If you look at debt levels obviously have gotten up, depending on how you look at it, whether it's central, general government, or maybe even a broader concept. Debt levels have risen significantly. But in our view, if you look at the public balance sheet, China still has what it takes to provide the additional support that is needed. I think the critical point here is, and that goes back to what Gurkai said earlier, China's fiscal policy, historically speaking, has been pro-cyclical. And it is critically important that policies are now more pro-cyclical. And this is not a question of intention, because the intention is there, as reflected in the work conference statements, but it's truly about implementation. Now let's move to the medium term part, and that I think is where it gets really difficult. Huang Yiping talked about the need to instill confidence. Households in China are very concerned about the future. That leads to precautionary savings, and that ultimately is not commensurate with increasing consumption. So we need a serious fiscal reform that instills confidence and ultimately allows households and consumers to save less. Now, the fiscal reform is needed also because there are increasing pressures that come from the demographics, with rising costs related to healthcare, of course, strengthening the social security, and also education. What is true is that if you look at high-level documents over the last year and a half, there is a recognition that this rebalancing needs to be supported by fiscal reforms. The third plenum talked about it. It mentions tax reform. The 15th five-year plan that will be approved in March also picks it up. But the key thing is now, and this is where we're early stages, to convert the conceptual into design, and then ultimately into execution and implementation. And here, the most important part is of the reform is China's revenue and taxes. Of course, there are many ways to focus on reform. Part of it has to do with, improving your expenditure. You can always do more. But in the Chinese context, there is one thing that really stands out, and that is China's tax or overall revenues have fallen significantly over the last couple of years, from 18.4% to 12.5% of GDP. If you look at the international context, that is lower than the average of low-income countries and significantly lower than middle-income countries. And again, coming back, this fall in revenues comes at a time when the need for additional spending, especially as it relates to social spending, is going up. Now, why is this happening? It is happening across all major taxes that China has, including the personal income tax and the value-added tax that I will focus on now. So again, when you talk about tax reform, you can have many different aspects, but I try to be strategic and focus on the ones that truly can make a difference and where China is a complete outlier. And the most important one is the personal income tax. If you look at the revenue collection that China gets from the personal income tax, it is 1.1% of GDP. That compares to 8% in the OECD average. And why is this? Is this because of bad administration? And the answer, no, it's not because of bad tax administration. It's truly because of policies that were put in place. China's personal income tax is characterized by a number of things. It is formally a very progressive system where you have a high marginal tax rate of 45%. But if you look at who is actually paying taxes, it highlights you that there must be something fundamentally wrong. Of all the people that pay personal income tax, 60% of those pay at the lowest marginal tax rate of 3%. That is unsustainable, right? And that is in part because thresholds are, for example, very, 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 they have very high thresholds, exemptions. And so the whole tax base is very, very small. So with a reform of the personal income tax, you can make a big difference here. We have an estimate, it could be about 5 to 6% of GDP. So the personal income tax is a very important part, and it's mostly just increasing the base. The second one is the value-added tax. Again, it's the most important part in terms of revenue collection. But here again, what we have seen is that through rate cuts and exemptions, revenues have declined significantly as a share of GDP. And again, why is that? It has to do with the different VAT rates. China has 13, 9, and 6. If you look at the European average, that's close to 21, 22%. So by bringing the rates up, harmonizing them, you can actually generate quite a bit of revenues. Now, what has China done? It actually passed a VAT law in December of last year, which is basically the first comprehensive law that codifies many of the things as it relates to VAT. And it has some key benefits. First of all, it creates certainty, transparency. But from a macro fiscal perspective, it has not yet addressed the underlying challenge, and that is raising revenue overall. Again, in our view, there is significant room to harmonize the rate and at the end of the day to marginally increase it. Exemptions should be rolled back, and of course, you can always do better on compliance. In the last part, again, very eloquently mentioned by Huang Yiping, is this central local government fiscal relationship. It has been mentioned in the high-level documents that needs to be rebalanced. And as he suggested, I think I would agree that a key part is to continue cleaning up the balance sheet. What China did in 2024, at the end of the day, it had a big debt swap program that helped local governments in the short term by reducing interest rates, extending maturities, but it did not fundamentally address the issue of the mismatch of spending obligations that local governments have and the revenues. So the clearing up the balance sheet part would be to actually, for the central government to assume with conditions attached some of the local government official debt onto the balance sheet of the local government and to continue with the restructuring of local government financing vehicles. And then, of course, in that context, to really enforce a hard budget constraint. And as Huang Yiping rightly said, realigning the spending obligations of local governments, passing some of those responsibilities onto the central government, and at the margin, providing additional revenues for local governments so that they truly can finance the remaining of the operation. So I think the challenge between the first part, which is the focus on the short term, where we argue you need to have more fiscal support, and at the same time saying, well, but you need to really have a fundamental fiscal reform that focuses on revenue mobilization and an increase in the revenue collection, not the rates, especially as it relates to personal income tax and the VAT, is to have a clear plan and then to communicate that clearly. If you can communicate clearly that the short-term support is combined with milestones that will ultimately put your fiscal on a sounder footing, then even if the medium-term reforms are not implemented immediately, you would still get the benefits of increasing confidence, and that ultimately then will help on the rebalancing and on the consumption. So the agenda is very large, but I think in our collective view, it is truly the fiscal that can make a humongous difference. There is a recognition by the government, both in terms of the short term, to provide additional support, as the Vice Minister articulated the last couple of days, and also having a broader reform to rebalance in the medium term. I think the question is timing, the magnitude, and ultimately the political will to move ahead, because as in any country, some of these reforms are politically not easy to implement.
Great. Well, thank you, Alfred. And I guess I'd be interested in what Yiping and Kai have to say and any reactions they have to your thoughts on China.
You know, I broadly agree with.
Sorry, please go ahead.
I think I broadly agree with Alfred's message. I think China has a challenge to raise tax revenue as a percentage of GDP in the medium term, particularly also given that the land revenue will not go back to where it is. I want to ask Alfred, you know, it is very hard to do a tax hike in any circumstances, particularly when the economy is not yet performing very, very strongly. How can we manage this tax increase as you recommended in China to alleviate the political concerns that might be coming with it? That's my question. It's not about the direction of travel or what should be done. It's really about how you do it. actually do it?
No, I think this is a perennial problem, I think, for all countries that face similar challenges. The argument I think that I was making is to move now from the conceptual to something more concrete, where the government could give itself enough time not to implement all of it instantaneously. As you say, you still have the headwind, but rather anchor expectations about the future of which way to go. You can also maybe in certain instances sell it a lot better by saying, you know, in this context of a personal income tax reform where we want to increase the base, right? You could actually say that you're willing to reduce marginal tax rates at the top, right? So you have like a good message, or not only at the top, but across the board, because ultimately you also want to talk to the middle class. That you're willing to reduce rates in certain cases, while at the same time, broadening the base. But that's why I say you can do this if you articulate. First of all, you have a clear plan. So to go from the broad brush to what are we really talking about? You have some clear statements. There are also benefits to this, and then you have to communicate this clearly. That markets and of course households at the end of the day buy into this, because you want to improve confidence, right? Currently, people have concerns about the future. They don't know what their social security system is going to look like. They don't know what their healthcare system is going to look like. And they don't know what educational spending is all about. And in that environment, the only option for me as an individual is I'm going to save, because I just don't know. If I can help them to see the light at the end of the tunnel, maybe that would work.
Great. Well, Alfred, I think we're coming to the end of our time, so I don't know if you should just conclude us.
I had one question here, maybe for that was sent to me, that refers to what was reported in a Rhodium report. That growth from new economic sectors will not make up for a drop in traditional sectors of the real estate sector and potentially infrastructure. So, how long will this transition last? And, which are the sectors that can one look at that truly can substitute this? I think that was the core of the question. And
The sectors, when we look at what could be the potential growth engine for the next phase of Chinese economy, in addition to, I think, what the government is focusing on, that is advanced manufacturing, new productive force, etc. I think there are two components of the service sector that could be we could have a lot of potential. One is really business service. China is lagging very, very behind in terms of business service. We don't have this type of AWS cloud service, those kind of big. You see what's happening, and advanced financial service. That's kind of legal consulting. Those kind of service that is quite prevalent in the US and in the West. That's one big part of the growth part that we can try to achieve. A second part of that is really healthcare. Chinese health outcome is pretty good, but we can do much more and to improve the quality and the health of the population, and by also spending a little bit more on healthcare. Of course, that would depend on how we can reform the healthcare system, but that part also have a lot of room to grow. In addition to advanced manufacturing and technology.
Thank you, Jason. Does anybody have a final comment
I don't.
I would just say it's been a terrific discussion and would say good night here from the United States.
I'll second that.
Thank you very much from our end. Thank you, Jason, Huang Yiping, Guokai. I would say to be continued. And of course, we're watching carefully what is happening in the next couple of days. So thank you very much. Good night, Jason. Thank you for joining us this late. Thank you, Huang Yiping and Guokai. And of course, all those who called in. I think also it has been a fantastic discussion. Thank you very much.
Thanks
Thank
for
you.
organizing, Alfred.